All right. All right. Ladies and gentlemen, welcome back to Trend Following with Tyson. All right. So it's me, Trend Following Tyson, you guys. And today we're going to cover some basic stuff on support and resistance and catching the trend. But first, I want to cover this support and resistance because it's absolutely futile for a trader to know what this is because these are like the pillars of trading. If you know what if you know what support and resistance are, I think it's like the pillars to trading. You can go so far with knowing support and resistance. Okay, and also support and resistance evaluates with trend lines because with trend lines it's kind of like dynamic support and resistance lines. Okay, so let's get to that today. And you guys, we're going to do some learning here today, and we're going to look at some of the stuff. But before we do that, of course, I like to take up a quote from someone special. All right, guys, we're going to take up a quote from Larry Hite. I was just kidding around. We'll take up a quote. He's special in mine. And anyone that's a trend following trader, Larry Hite's very special. But anyways, just some quick info for you guys that don't know who Larry Hite is. He's one of the most well-known trend following traders. He's very wealthy, and he's traded along with some of the best trend following traders in the world and some of the best hedge fund managers in the world. But here we go. Larry Hite is a hedge fund manager who, along with Ed Seykota, is one of the forefathers of system trading. Okay, that's just a quick piece. Now let me give you guys something else. Larry Hite. All right, now let's take up a quote from Larry, you guys. Let's take up a quote. Make sure you guys can see this real quick. All right. In case you haven't seen Larry Hite, that's Larry Hite right there. All right. All right. So this is going to have to do with some of everything we're going to deal with today. And I just like to have some of my points backed up by well-known traders because, you know, it's not like I'm just saying these things and I don't know what I'm talking about. Throughout my trading career, I have continually witnessed examples of other people that have known being ruined by failure to respect risk. If you don't take a hard look at risk, it will take you. I'm sorry, you guys. I may have failed to tell you guys what we're doing today. I may have left something out. We're going to be looking at risk-reward ratios, and we're going to be looking at some good risk-to-reward ratios and how you can kind of measure them out and put them inside of your trading so that you can measure your risk to reward in every trade that you make so that you don't get ruined. And as you just seen from Larry Hite, this is a very key part. Okay, if you don't take a hard look at risk, it will take you. It is incredible how rich you can get by not being perfect. This is what Larry Hite is saying about not being perfect, you guys, is you don't have to catch the top and bottoms. You don't, and the main thing he's saying is that with a 50% win ratio, you can become very wealthy. You can create some wealth, trend following and trading. Frankly, I don't see markets. I see risk, rewards, and money. This goes back to my point. You guys. While some people, you know, I'm not going to say that they get on my nerves, but some people say things like, some people say a lot of stupid things, like this is a good stock and this is a bad stock. There's really no such thing as a good stock or a bad stock. There's only a such thing as stocks that are going up and stocks are going down. Because think about it, to the stocks that are going up, they're good stocks. To the stocks that are going down, they're still good stocks because shorters are taking opportunity on those stocks. So there's opportunities to be made. We talked about that last time we were here, you guys, about if you're playing on a football team, you know, there's a running back, there's a quarterback, so play your position. All right? So I just wanted you guys to see that, all right? I just wanted you guys to get a good perspective. I just wanted you guys to get a perspective for someone that's well known, for someone that's well known in this aspect and has been very successful and kind of knows what he's talking about, all right? So don't take it from me, take it from Larry Hite, all right? So let's go back here, and I already have a chart pre-prepared, all right? So we're done with Larry. Thank you, Larry Hite, for your quotes today, for your valuable information. I'll make sure that it's my duty to make sure that while I'm doing this cast and while we're checking all this information and learning and kind of delving into trend following and the education aspects of it is that I make sure that the forefathers, as you just saw, he is one of the forefathers of system trading, and he's one of the forefathers of trend following. So it's my duty to give respects where it's due. Okay. All right. So here we are, you guys. Look at this chart on EBIO, and I kind of already know that it's well positioned for you guys to take a look at. Oh, here we go. Make sure that it's good. All right. So let's look at EBIO, you guys. All right. I'm looking at some support and resistance levels already. This is support and resistance. Okay, support is the level of a stock where prices can no longer be pushed, and it's also a level, it's like a chair. It's like a chair. Like a chair supports your butt. Well, supports the stock. A stock. It's like it supports the stock's butt. It's like a chair. Look at this. This is a support level here. I didn't mark it on I didn't put a line underneath it. This is a support level here. Long-term support here. See the stock being unable to be pushed below this? This is where you can set your risk to reward, and we're going to get to that now. Let me show you the support levels first. Okay, this is support. Stock is unable to trade lower. Let's closing it up a little bit. Okay, the stock's unable, and look at this, guys. It's not a myth. All right, on the yearly time frame, okay, the same support level stand on different time frames. You guys, we're clicking through different time frames. The same support level stand. Do you see that? On the yearly, the same support level stands. On the 6 month, the same support level stands. More than likely here, the same support level is going to stand. Okay? Support levels, guys. So, let me go here and show you something really quickly. So, this is how you base your trades. This is how you get your risk to reward ratios. Okay? And the way I see things, trend following, you get a way better risk to reward ratio, because you're not going for just 20 cents and 30 cents and 5 cents, which is nothing wrong with that. But in trend following, you're going for the bigger move. We're following the overall trend, the predominant trend, okay? Now, see this move here. If we were at this point of the chart, I'd like to take, let's just say that the chart is here. That all this doesn't exist. None of this stuff exists. Let's just say we're right here on the chart. I'd be taking an entry here. I'd be looking to take an entry here at $1.99 at $2. See this? Key support levels at $2. It's not like how do I say this? It's not like an accident, you guys. It's not like a freak of like weirdo-ness. This is actual. It's because, I don't know, whole numbers, you know. Stocks sometimes like to sit on whole numbers and half numbers. At the 50, you know, just below the 50, here's the 50. You know, stocks sometimes like to sit on key levels, like whole numbers. But anyways, if we're looking at a support and resistance level, this is support. This is kind of like resistance here, because the stock was unable to push through here. It was rallied up, unable to push through here, push, consolidated, kind of gave you a support level here. Okay? Kind of pushed back down to this support, and then it kind of traded on this chair. It sat down on this chair for a while, so to speak. Okay? So you put your stock just below the chair in case the stock falls off the chair. It's your support level. So you say, I want to get in at 2. In case this stock falls off his chair, I want to get off of this thing. Always give your stop some buffer space. Okay? Let's say 185. Really, it'd be here. But your support level's here. Your entry's at 2. You don't want to start taking too many points off of your entry. That's only 7 points, so this is good. Your stop out here. In case things get funky, the stock kind of breaks below this support level and it bounces off of it. Give it some room. So this is your support level. Support moves up in an uptrend, you guys. It goes here, it goes here. One other point. Support, old resistance becomes support. Stock was unable to push through here. It was resistance. Okay? Then it finally pushed through that mark, pushed through this mark here. It pushed through there and stopped here. Kind of found support at this old resistance level. Okay, stock pushes through here, finds support here. This is your support, buffer space, and actually came back here. Old resistance, guys, turned support. So here's an old resistance level. See this? Bang, bang, bang. Stock's banging, basically. Let me give you guys a trend line. Stock's basically banging here. Bang against this line here. Bang against this. It finally breaks through here. And then turns this old resistance into a chair now. It's sitting on this level now. See? All this sitting here on this support level. That's why I was able to like kind of rebound itself, because this was old time support back here and here. Okay? So the markets are about risk to reward ratios. You want to give yourself a good risk to reward. So let's say your entries here, we just looked at this risk to reward ratio. We just looked at this support level. So here's your support. Your stops below, let's say your stops below 185. Let's say 180, which is 180 here. It's a 20-cent stop. So at $2, you had a 20-cent stop. But from $2, you're at $2.51 now. So you've doubled that. That's 2 to 1. Because 20 cents, you were going to get stopped out at 20, but you didn't. Instead, you made more than 20 cents. Okay? You made 40 cents plus 10. So it's a 2 to 1. It's a 2 to 1. I mean, it's 1 to 2. For every dollar you're risking, which is the 20 cents, is $1, you're making $2 back. Okay? Because you're making 20 at $2, you're making 20 here, and then you're making 40, which is double your 20 you're risking here, plus 10 cents. So it's for every $1 you're risking 2. That's a good risk to reward ratio. You need to know that by knowing what your support level is, okay? Also in trend following, you guys' risk to reward ratios get way better. And let me give you an instance of that. Here was old support here, and I already marked it. Old support here at 140. Let's say you give it a stop here at 130. Here's some junk right here. 120. 20-cent stop again. Entry 140. Exit 120. Okay? Below all this junk. So if you made an entry at 140, all right, for your support level, you want to get in to your stock as close to support as you can. As close to support as you can get. That way you know where you should be getting out at. You don't want to enter into a range up here. Okay? You enter down here at where the stock's sitting down. Okay? 9 times out of 10, guys, when you get this kind of up movement, gap up movement, little pullback, when you find support, 9 times out of 10, a stock will move upwards. If you gap up and the predominant trend is up, stock finds support, 9 times out of 10, it will continue. Okay? That's just the laws of nature, you guys. Try stopping a bus at 100 miles an hour. Okay? Alright. I rest my case. Anyways, good risk to reward ratio, you guys, by doing trend following. Why do I say that? Because you make your entry here like normal day traders would do, and they say, okay, I'm getting out if it gets funky here or here. Day traders kind of keep a tighter stop because they take larger positions. Trend following, you don't take very large positions because you have so many trends to ride. We'll talk about that too. adjusting your portfolio and your entry positions based on what you have in your portfolio and your risk. Anyways, so we're risking 20 cents, but we're going to make a whole dollar. That's it's like 5 to 1 or 1 to 5. For every $1 you're risking, you're making 5. For every $5 you're risking 1. But it's really 1 to 5. Okay? For every $1 you're risking, you're making $5 back. Why? Why do I say that? Because you entered here at 40. You entered here at 40. You risked 20, but you never got stopped. Let's say if you made this entry here, you definitely never got stopped out here. Okay? You definitely never got stopped out. It came to 135, but it never came to 120, which was your buffer space in case something went wrong. So you never got stopped out. You made an entry here at 140. Stock never broke below 120, which was your stop out space. So for your 20 cents, 20 goes into $1 5 times. Okay? So that's 1 to 5. Alright, you guys? That's support and resistance and giving you good risk to reward ratios and catching trends. Okay? That's a great risk to reward ratio. Every time you trade, you should be looking to give yourself those. Okay, guys? All right. I'll give you a good risk to reward ratio right now. A stock that you can look at as we speak. Okay? VHI. This stock clearly on an uptrend. We're above the 200-day moving average like we spoke about before. Okay? The 20 is above the 200. The 20 is above the 50 as well. The 20 is above the 150 and the 2 right here. I would like to imagine it is. I'm not going to put it up now. Anyways, so here's a good risk to reward ratio, you guys. All right? This stock is evidently, in my opinion, it's going to break through this sometime. It's going to break through up here. It's sitting at support. It's kind of inside this area. Let's pan in here. Okay. Sitting inside support. Take your entry here. You can take your entry now. It's basically sitting on the support level, guys. Your stop is below here. It came below here once. I don't know. Support level's here, 852. So you can take your entry now at this closing price at 861. Give yourself about a 40-cent stop. That's kind of you gotta have some space for your stop. Let's tighten up a little bit. Because this stock could come below here. It could come to 822. So you don't want to have a very tight stop on this one, guys. Okay, but it's a nice risk to reward. It's giving you an idea of a risk to reward. You're going to risk 40 cents to make. Look at the upside, guys. Kind of crappy looking there. Okay, to make, let's say we're going for $12. 40 cents to make. You have a 40-cent stop to make $3 to $4. Okay, that's another 4 to 1 risk to reward ratio. That's trend following, because we're here to capture the big move. We're not here to capture 20 to 50 cents. We're not going to capture 40 cents, which was our stop out limit. Even if we had to break even, would be fine. Okay, so that's support and resistance, you guys, and risk and good risk to reward ratios. The markets aren't about good stocks and bad stocks. They're about stocks that are giving you good risk to reward ratios. Okay? Don't ever forget that. Don't let no one talk you guys into this crap. About this is a good stock, this is a shitty stock, this is a bad stock. There's no such thing. There's stocks that go up and down, and where you place your risk management in between them. And the money that you can make. You just saw it from Larry Hite. You didn't see it from me, guys, alright? Alright. So, I just gave you guys something, okay? So we'll come back on the next. We'll come back tomorrow, and I want to talk to you guys about buying some new 52 highs. How do you go about doing that? We just covered support and resistance and dynamic support, which this is dynamic support, guys. When you're in an uptrend, okay, and you can't just typically really find a support level, this is dynamic support. When you get a stock that's making this move here, from here to here, which is here's my other favorite pattern, this rounding pattern, rounding bottom, showing that if you guys remember one thing for me, you guys, remember this pattern too, this rounding bottom pattern. You will make a lot of money here. I'm telling you so, okay? I have made tons of money here, and it almost never fails me. This is signifying that we're denying lower prices. We can't trade any lower anymore. So prices are getting pushed higher. When prices broke above this, that was a buy signal. Okay? Boom. And then look what happened. Even if you want to, this is so, I love this trading so much, you guys. I love this so much because it just gives you so much to go off of. All right? Let me tighten it up, see if it'd still give us the same portion. No, it wouldn't. Anyways, let me show you on a different time frame. If we're here, guys, see this long time settlement? You break above that, that's a buy, guys. Okay? Okay? So that was a breakdown on some key elements on risk to reward ratios. For every dollar you're risking, you want to have a reward of, some people say 2 to 3. Trend following, and then from my trading aspect, I say 5 to 6 or 4 to 5 at least. Because I'm trend following to make the big move. I'm not trend following to break even. Okay? All right. So, thank you guys, and I will see you guys here tomorrow. I'll cover some new 52s and how to trade new 52-week highs. And also I'll have, don't miss the big move. I'll give you guys some trend, some stocks that are up on an uptrend to watch for some entries, so that you're not missing those big moves. One of those stocks I'll give you guys now before we close up is going to be VHI is one of them. We just looked at VHI. It's the reason why I showed you guys VHI, because it's on an uptrend. Here's another stock though, you guys, that I'm going to mention tomorrow on key stocks that are in an uptrend that you shouldn't be missing if you're a trend follower. I'm not saying this is the only stock for you to catch, but I'm just saying, okay? I'm long on this thing here. A lot of people scared to trade this move, but not me, because it's defensive trend following. Defensive trend following is when you see a stock like this headed up, taking a big move, you're going to trend follow that. Of course, you're going to take an entry. You don't know where it's going to crack. You don't know what's going to happen because it's getting parabolic. But what you do is you take a lighter entry than what you normally would take, and you give it that 1% stop. That 1% stop. That 1% risk. 1% means, you guys, if you had let's say if you had $1,000 account, okay? If you had $1,000 account, you're going to be stopping out at 60. Okay? $60 is your 1%. Okay? If you had a $6,000 account, let me do the math really fast. Hold on. This is for you guys that don't know what the heck do we mean by don't risk more than 1% of your capital on any trade. Period. Okay? All right. So yeah, guys, 1%. All right. So you can't afford to lose more than 60 cents on $60 on one trade, guys. All right. Because if you lost $60 100 times, that's 6,000. Okay. All right, guys. So defensive trend following, taking a lighter position than you normally would take. Say if you're a trend follower, some people take five. You know, no, they don't use more than 5% of their position on any one trade. They don't use more than 5% of their annual trade amount of their account net worth of what their account is worth. Okay, and they have a 1% stop on that. Okay. All right. All right, guys. I'll see you guys tomorrow. Thank you for coming out.